Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show, recording in our 10th year of delivering this podcast. I need to come back with an official formal date where we celebrate and mark 10 years in podcasting, and a lot of people think it's a new thing. Well, I can tell you, after a decade of podcasting and many thousands of podcasts, it's not a new thing. However, it's gained a lot of currency these days, and more people than not are tuning into podcasts, which is pretty good. It's part of their pathway of education, whatever in, or interested in whatever they are. There's a lot of podcasts out there. Most podcasts don't last sort of 4 or 5 series before people get bored of them. So doing this for 10 years, I think, is a real indication of the value it is creating for property investors right across the nation, and also those people connected in and around property managers, real estate agents, accountants, everyone that's part of the property economy. And we're hearing a lot about it. It's now official. We are in the election cycle. The Prime Minister went and saw the Governor-General a couple of days back and said, hey, it's time for the election. The recommendation is that we dissolve Parliament. There were some cannons that got fired, which formally marked that, and now we're in a caretaker mode with government. So pretty much nothing's going to happen. Everyone's just going to be doing what they have been doing, so I don't expect much to be happening there. But we are all going to the polls on the 3rd of May to actually work out who's going to be the Prime Minister moving forward. Is it going to be the current Prime Minister, Anthony Albanese, into a second term, or are we going to see a change in government under Peter Dutton and the Liberal National Party? Who knows? Everyone gets to have a vote. That's the great thing about democracy. Whether it's going to change anything, who knows? Today we're going to pull it apart. We're recording this just a week after the federal budget was handed down, and subsequent to that, the Prime Minister announcing the election, which in many ways was done pretty soon after the opposition response to try and scupper any noise or news they had around it. Joining me in the studio, someone who's a bit of a political flunky, more so than me. I'm just a struggling journalist trying to get ahead. Liam Garman is actually the managing editor of real estate here at Momentum Media, but more aligned and connected with the machinations of politics than myself. Liam?
Well, it's just because I have opinions. I get fired up.
You're not allowed to have opinions.
I know we're not allowed to have opinions. But you know, you were talking about the benefits of podcasting.
Yes. Allows us to have opinions.
Allows us to have opinions because we label it. That, you know, this is my opinion, but and I do want to say one thing, because 10 years of SPI podcast, and it is really interesting every time. Well, not every time, but it's actually, you know, maybe sometimes more often than not, when we have investors come on the SPI show and now they've scaled up to 10, 20, 30, 40 properties, and they always say they started their journey from the SPI magazine.
It's crazy, isn't it?
Always.
Who would have thought?
Yeah, and when they thought, hey, this is something I want to get into, and they'd go into the newsagents, buy SPI as a magazine. And that was you were the editor of the SPI print,
Probably
or
was.
the publisher.
Yeah, back in the day.
Back in the day, and now you've taken the reins here, and you've created a lot of wealth for Australians, Phil.
Oh, well, maybe. I hope so.
Yeah, well, I mean, there's a
so.
lot of people coming in hand on heart that it was SPI that gave me the tips and tricks that I needed to scale.
Well, this is, and I get great satisfaction out of that. And you know, people come up to me on the street and sort of stop me and go, oh, thank you. You know, it's like you get a lot of anecdotal stuff, which is pretty cool. You know, when we started this podcasting was relatively new. This is one of the sort of original property podcasts. Now there's probably about 1,000 property podcasts.
There's probably as many podcasts as investors.
Yeah, probably.
Yeah. Everyone's got their own podcast
Everyone's got their own
nowadays, yeah.
podcast now. And I'd say that's a good thing that there's all this information washing around out there. Most of the podcasts out there are created by or delivered by, you know, people who are in the business of making money through property. Buyers agents and that sort of cohort, which is cool. And they've all got different ways of doing things. They've got different strategies and different ways in which they want to sort of connect and engage and provide or create value to their audience or their customers, their clients. This particular podcast is independent. You know, we're a media company, and we produce this for the purpose of
and to people that just love
content.
property.
Yeah.
You know, it's people that love property that don't necessarily have those business connections of, say, you know, a buyer's agent come to me. And actually it was really interesting because now I don't even have the full story, but about 30 minutes just before we started recording this, Phil, Melinda Jennison and the Rebar came out this morning saying, do beware of kind of DIY buyers agents that are out there, and I see it all the time on Instagram, Phil, where I'm scrolling, and some of the advice, which to be honest is actually now just financial advice that a lot of people that they're putting on Instagram to try and get leads. I look at it, I'm like, this is so fundamentally wrong. Now, we obviously partner with a lot of buyers agents who are fantastic, and we vet them. We speak to them. We know that they're the real deal. But when you go on social media and you see people out there that are looking for a quick buck, and it is a little bit worrying.
It's the Wild West. Let's be clear, it's the absolute Wild West. And when I go on social media, and like after a day of working in and around property, the last thing I probably want to do is get property stuff coming into my social media feeds, but it does. And it's either... and this isn't a beat up at all, but I'm just providing an observation. It's either people give me content on how to be a better property investor, and or people trying to sell me courses to become a buyer's agent, telling me that it's a great side hustle. You can make $20,000-$30,000 a month by having a part-time job being a buyer's agent, and et cetera, et cetera. And when I see that and hear that, and I've been talking about this for some time now, I think we're really at an inflection point for the buyer's agency sector, and we need to exercise caution as an industry because it is certainly coming of age as the sector. It's becoming normalised to be using buyer's agents rather than only the handful of people using them, which is great. And hopefully the outcome is that Australians are making more informed property investment decisions. That's a good thing. However, it's a pretty low barrier to entry. I could finish my job today and be a buyer's agent tomorrow. I can go get a real estate license over a weekend to allow me to operate. So you've got to exercise a due sense of caution when you're choosing the people who you're working with as part of your wealth creation strategy. I'm all for using professionals to help you out, but not all property related professionals are created equal, and I'll tell you that. And property over the years has been an attractive home for what used to be called property spruikers. They're still out there today. They just come with a different guise. So buyer beware. I would say.
Now, I mean, and to that point, I use buyer's agents. I reckon they are. I do believe that they are a real good tool, a good crutch to make sure that your investment decision is on the right track. But yeah. I mean, to your point, these people coming out with a side hustle mentality. Well, not really. I don't
want to be investing my financial future in someone's side hustle.
Yeah,
I'll tell you that
if you're already working a 9 to 5, how are you actually delivering for me between 5 and 9? Are you just scrolling through realestate.com.au? Now, great listings, sure, but you're not actually offering a service I couldn't do myself.
Yeah, I wouldn't go to a part-time surgeon to get something done. I wouldn't go to a part-time accountant to get my finance done. I wouldn't go to a part-time mechanic to get my car fixed. I'm not going to go to a part-time buyer's agent or part-time property professional for the purpose of what is significant financial decision making. And I frame that with the point which I've made for the last 10 years. The first property you buy as a property investor is absolutely critical. Are you going to outsource that into the hands of a part-timer to make that call? Because if you get the first one wrong and the second one wrong, guess what? You're going to be one of the statistics of people who had a bad experience investing in property. And guess what? There's still a lot of them out there. All you hear is the good stories. There are still as many bad stories and negative stories as property investment. And it's getting harder to make money in residential property investment. I've been talking about that. There's this myth still that you're going to become a bazillionaire overnight investing in residential real estate, or you're going to be able to create a passive income quickly of $150 or whatever $1,000. Like, it's a myth.
It takes time. It takes a lot of time and takes a lot of research. And, imagine that, you got your part-time BA and, you got a contract negotiation. Oh, sorry, I'm in a meeting, actually. I can't jump on and speak to the real estate agent for you. Or, we need to chase up the contract. Oh, can't do it. I'm at a client lunch with their 9 to 5. You're banking on these people prioritizing you, which is why you pay for the service anyway.
That's not what we're here to talk about.
That's not what we're here to talk about.
I wanted to talk to you about the outcomes of the federal budget. So the budgetary analysis around that. And also, as we move into the federal election, what does it all mean? Welcome back, Phil Tarrant, host of the Smart Property Investment Show with Liam Garman, sometimes host of the Smart Property Investment Show, but today
I host it quite often. Yeah.
You enjoy
I do
it?
enjoy it. I love it.
Yeah.
You've
gone mad for property.
Yeah, you hoover up all the intelligence and all the amazing insights from our guests who are far smarter than I am. I just ask the questions and I learn.
Do you know how many people would kill for the opportunity to sit in front of Australia's best and brightest minds
in
property investment?
That's
and ask them any question they want.
I know.
Ask me a question. I'm one of the.
We did have a very, very, very successful investor in BA on a few weeks ago, and we walked out of the studio, ran into you, Phil, and he said, I got the feeling, during the podcast, you were just asking me the questions of areas that you wanted to close your knowledge gap on. I'm like, yeah. Yeah. But you know what? If I have a knowledge gap in it, I'm assuming a lot of people do as well.
That's the best way. And that's the key to podcasting is curiosity.
Yeah. Yeah.
And sometimes being courageous, asking the questions that you think are going to make you sound dumb. But I tell you what, it's those dumb questions that you ask and I ask, and I'm happy to look a bit dumb sometimes. I don't claim to be knowledgeable. That people are going, oh, thank God someone asked that question because I wanted to know about it.
We are at a weird period in the world of investing, Phil, which is a majority of investors are still the 1-2 investment house owners, right? There's that. And then you're going to have a whole new generation of people who become the accidental investor, which is through inheritance primarily. We're seeing, and this is something that you speak to very often, which is we're seeing in Australia's history, the largest transference of wealth between generations. So you're going to have a lot of people that become accidental investors that are like, okay, now I've suddenly got skin in the game, I need to quickly learn. You also have a whole new generation of young Australians who, whether they're in Sydney, Brisbane, Melbourne, might now invest out of necessity through rent vesting because you might do the calculations. Well, actually, I'm priced out of an entire city, and hey, this rent vesting thing actually works really well. And actually, I might be able to make more money off rent vesting than buying a PPLR, just because of how the yields are going to stack up. So we're at a real turning point where we do have a lot of people who are entering the game for the first time in 2025, and it does dispel that myth that, it's over for people. And it's a very prevailing myth, it's a very pervasive myth, especially young Australians, that, oh, no, it's too expensive, it's over. I'll never be able to get in. No, listen to this show, get the tips. There's always a way that you can make it.
And that's a really good point. I went to a briefing yesterday around property with one of the major banks down in town, and there's a couple of spokespeople there from Oliver Hume. And they pretty much spoke to what you just mentioned, and I don't want to be the merchant of doom and gloom, but the reality is that it is not accessible for a lot of Australians investing in property unless, and then there's a caveat to it, unless they change their frame of reference around it.
Yes.
Sort of greenfields, and they spoke around greenfield development sites out in the burbs, right? Whether it's Sydney or Melbourne, and their position pretty much was, and I'm paraphrasing, and I'll actually get the presentation so we can pull it apart. He said first home owners aren't buying brand new greenfield development properties in the suburbs of Sydney on the fringes. This sort of greenfields development out purely because they just can't afford it. It's just they are priced out of the market in Sydney and Melbourne. They're priced out of the market. So this idea for your average, if you want to call it first-time buyer, that they're going to be able to go and buy a house in Sydney as their first home, not possible. You're saying you've got to buy in the unit market. If you want to buy your own home as a first-time investor, it's a first flat. It's not a first house, purely because they can't get the borrowing. It's impossible. The arbitrage between, the difference between what you need as a deposit and therefore what your loan is versus what you're able to afford is out of kilter. So for a lot of people, that's a tough mental shift to actually go, I'm not going to be able to get married in my 20s and maybe have kids, get married in my 30s and maybe have kids, get married in my 40s and maybe have kids, and buy a 4-bedroom, 2-bathroom suburban home. They're saying that doesn't exist anymore.
Well, that's done.
Not done.
With medium density housing, a lot of those old old suburbs anyway where, we might have grown up and don't exist anymore. I'm from the inner west and, I catch the train through and actually a lot of the suburb doesn't exist anymore because of going up to apartments anyway. It is a frame of reference. We live in apartments.
Yeah.
But there are still good and affordable apartments, even in a good part of Sydney. I was only looking this morning on sold price on realestate.com.au. There are still apartments in Neutral Bay going in the 800s, which is, in terms of beautiful, high quality units in a very high in demand area. Actually, that seems quite reasonable.
Yep.
At a price point. So,
but this is it. It's the frame of reference that people need to change and shape. Like this idea that you're going to buy a home as the first home, like your home is going to be an apartment.
Yep.
That's it. But anyway, the government obviously is trying to look at the inverted commas affordability crisis, the cost of living crisis, and we saw that sort of handed down in the budget last week. Your overall view of the government budget?
Well, you're my boss. How much opinion can I give?
As much as you want.
Okay, good. But we're no swearing.
You can't swear.
No swearing. Okay.
And you got to play the ball, not the man.
Okay, play the ball, not the man.
That's the
rules.
Play
okay,
the ball, not the man.
I thought it was a remarkably underwhelming budget. And we do have a very large and growing team here at Smart Property Investment Show and also with our related brands. And for people that might be working in real estate as a business, we've got Real Estate Business REB. If you're not familiar, go up online. For our brokers, we have Broker Daily as well, that work kind of in that family of publications that we've got here. And we've got a very big and growing team. And we all came together and at the outset, I was like, there's not been much news and much announcements kind of pre-briefed to the Oz or the AFR. Property's going to be massive for this election. Get ready. We're going to be in the weeds. We're going to be up till midnight. All hands on deck. Didn't really happen. Everything had come out in previous years. I was remarkably unimpressed, to be honest with you, Phil, and that is an opinion. So national housing called 1.2 million houses to be built to fix supply issues, unchanged. Now, the government is tens and tens and tens and tens of thousands of houses behind already. Now, keep in mind, this is by 2029 that we need 1.2 million houses. They've given themselves quite a short time frame here, and they're already tens of thousands of houses behind, but no change. It's just, it's marching on. We saw 10...
Sorry, just to that point there, and I took a photo of this slide yesterday around housing supply. The 5-year target, this is New South Wales, the 5-year target for new homes is 329,000. Therefore, the annual target divided by 5 is 65,000 per year in New South Wales. Therefore, the quarterly target is 16,450, right? So New South Wales needs to build 16,450 houses a quarter. Now, the last print of information we have on this is September 2024. They built 11,220. So this is at the start.
In a quarter.
In a quarter, right?
So 5,000 a quarter behind, 20,000 a year behind. So if we go, that's
so
100,000 houses.
Already, 1 quarter, 32% behind in the first quarter.
Yeah.
And you extrapolate that out, we're going to fall so far short.
So far.
Now, to frame a reference. But back to what you're saying. Now, that's at a state level, and I need to acknowledge state governments are largely responsible for the building and everything around it, and local governments, so the federal government can have plans.
And, but with that, I give credit to Chris Minns and the state government because they've identified ways of streamlining the approvals process. I mean, we're seeing councils, Phil, where approvals can take up to, over a year, right? Where they've got designs which are pre-approved in areas which are pre-approved, so then you can completely fast-track the approvals process, which I think is actually a very reasonable way of doing it. But at a federal level, there seems to be no fundamental change to the National Housing Accord. Obviously, we've had a 20% cut on HECS. Now, this irks me a little bit, and it's not. I'm actually about 1 month from paying off my HECS.
Oh, are you really?
It's taken me 12 years, but 1 month away from doing it. Now, this isn't one of those things, well, I never got there. That's not about that. It's pure economics of what we're looking at. So you've got the government giving $10,000 to employers to support trades and apprenticeships.
Yep.
Now, you've also cut HECS debt by 20%. If you have such a shortage of tradespeople and apprentices, you should be incentivizing them going into trades, not making university cheaper and easier to get into, because now what you've done is, to be very frank with you, Phil, you've got a lot of people coming out with Mickey Mouse degrees that should not have gone to university. Now, I'm not saying you shouldn't go to university. If you want to do a history degree, if you want to do an arts degree, great, you should pay for that, because ultimately you come out after 3 or 4 years, ultimately unemployable. You should be bearing the brunt of that, not the taxpayer. But now, because we've incentivized people going to university, now no one wants to do trades. So now we have to pay more for a future generation of tradespeople. So it's a double financial hit there, that we're now on the one hand paying off people's HECS for them, but then on the other hand having to incentivize people through cash incentives to go into trades.
Yeah.
That doesn't seem to add up.
I have some pretty firm views on this, and what I would say in the pub is probably very different than what I would say on air.
Yeah.
However, I can give a more sanitized view of it. I think it's probably one of the most idiotic things I've ever heard in my life from a government to do that. Now, back in the day, university education was free. You know, it was free, and then it turned into something that you paid for, right? And cool. There's a lot of countries provide free education. Global Scandinavia, for example, and they all that sort of stuff, right? But this was back in the day when only a handful of people went to university. Yeah, comparative. Like now, most kids want to go to university because they all want to come out and be podcasts.
Yeah.
It's like the job everyone wants these days. Like, be careful, guys. Like, all those podcasts that are getting created, all these influencers, right?
It's not as glamorous as it looks.
None of them are making money. No, they're not making money. Like, just be careful, right? But why should Australian taxpayers have to pay for supplementing university education that's already taken place, of which we're not getting any additional value from it? It is a blatant buyer of votes, and I'd like to think people see through that pretty clearly, and I just don't understand. Put that money into something else. Give that money to employees to pay tradies more money. There you go. You're going to fix a lot of the attraction problems around it. Yeah, I speak to a lot of tradies. I've got tradies that do stuff for me. It's a tough job being a tradie. Like, you start doing it when you're like 16, 17 years old, and it's relentless hard work. You're up early, you're working long hours, you're typically working 6 days a week, sometimes 6.5 days a week. Nothing glamorous about being a tradie. People think all tradies are rich and wealthy now because we have such a shortage of trades. It's still bloody hard work, right? It's
hard work, but you know what I would say to young Australians that might be listening to this, if your folks have SPI playing in the car, but, you have a good future though. Yeah, and it is hard. It is super hard. And some of the stories are like, gosh, the 3 a.m. starts and everything.
Yeah.
But you probably have a better chance and a better roll of the dice than if you studied a degree that's not going to get you anywhere.
Here's a mad idea. So I'm sitting around and in government, and I go, we've got to fix this housing affordability problems. Here's a great idea. Let's make it easier for university-educated Australians with a HECS debt to get debt quicker by paying off some of their debt. That's going to make housing affordability better. So we're going to accelerate more people into the market faster, which is going to even put even further upward pressure on prices, which is going to raise prices.
That's exactly what
What a great idea. And I'd also say a lot of these younger Australians with HECS debt, you take 20% off their total bill. It's not going to move the needle on how much they're earning, right? So say that 20% goes into saving for a home deposit, right? Fair enough. I sort of get that. It's not going to really change your serviceability position unless you can change your own personal balance sheet, right? That means you need to earn more money to increase your serviceability. The machinations of a HECS debt is only a small, application when you're looking at the serviceability of it. So who would think that is a good idea?
So the serviceability, Phil, is what I was literally about to turn this into next. I'm glad you've brought it up because only a few months ago, the government said that if you have a HECS debt, it will no longer count for your serviceability calculations, which, oh my goodness, has to be one of the It's stupid. It is so I can't even put into words because, to your point, you don't actually have when you're calculating into the serviceability. It's not suddenly that at the end of the fortnight or at the end of the month you've got more money in your back pocket. It's just that they're not going to count that debt to your serviceability, your mortgage equation, right? So now they can borrow more, but now they're just losing a bigger chunk of their paycheck to their mortgage,
Correct.
Which puts us in a very dangerous financial position as a country. One of the reasons that Australia is more or less immune to the vicissitudes and the fluctuations of the global property market and global asset market is because we have very stringent ruling criteria. That is why, despite 13 interest rate rises or whatever it ended up being, despite COVID, despite ups and downs in the job market, despite all of these things, that's why we never saw a huge flow-on effect and huge ramifications for the property market, not like, say, the 2008 credit crunch in the US where you saw some areas in the property market absolutely decimated over the course of about 6 months. Why? It's because we did the calculations to make sure that even with slight economic moves, slight financial moves, that people would still be able to pay back their mortgage. This flies in the face of that because now you're letting people who might have a $60,000, $70,000, $80,000 debt because they've done masters after masters after masters, having the ability to borrow now essentially more. Now, yes, that debt doesn't get passed on to anyone else. Yes, that debt doesn't get paid if you suddenly fall under $55,000 a year. But you know what else doesn't get paid if your income falls under $55,000 a year? It's your egregiously big mortgage. Mm-hmm. So that part of the equation doesn't actually add up. And I thought it was a terrible vote for vote buying.
Well, alongside the $150 in energy bill relief.
Yeah.
Here we go. Let's fix the electricity issue just by giving everyone a little bit of money to help pay their bills.
You're not actually fixing the underlying issue.
It's an absolute joke. And this comes back to it, and I say it time and time again. There is no big, bold, ambitious plans for Australia to give us a pathway, a pathway into the future, decades, around any of this.
The nation-building aspect.
It bothers and it concerns me so much. Everything that's come out of this budget, I just sit there and I scratch my head. Like, really? Like, $150 is going to make a difference. And what is it? We're going to be getting lower income Australians are going to get tax cuts of $5 a week in any year. It's like, I just don't understand it. And I look at the summary that our team put together on this. There needs to be, and this is an important point, there needs to be an intersection between the types of policies that the government is introducing to support a particular cohort of Australians around housing, and there is the policies for the other cohort. And the other cohort is your Australian who wants to be part of the property economy and wants to buy their own home or invest in property. That's one cohort. The other cohort are people who are outside of that. They're on the fringes, and whatever example, they need support and assistance for whatever reason, for housing, for shelter over their heads. And it all gets bundled up together. And by that I mean, there was $1 billion fund for crisis and transitional accommodation and investing $6.2 million over 3 years to support leading homelessness organisations. That is one thing that falls into that bucket. That is something very different than how to make housing more affordable for your average Australian on the street. Rolling out the first 2 rounds of $10 million Housing Australia Fund, right? Delivering 18,000 social and affordable homes for those who need it the most. That falls in that bucket around crisis accommodation, right? Like, the government has an obligation to ensure that our nation's most vulnerable are housed, right? They have that obligation. And that is a very, very different part of the property economy than property investors and homeowners buying a home and looking to create wealth through it. Two very, very, very different things.
They do put it into the same bucket because every time you do have a housing announcement, it does fall on the social and affordable housing end of the spectrum, which, again, is correct, and we should be doing things to help vulnerable Australians. But what if you're just trying to have a go?
You're just giving it a crack, right? There's higher income gaps and property price limits for shared equity help to buy scheme in a bid to help more first homeowners enter the market. That goes back to my original thing, my original point around okay, I get that. They're very limited spaces. It's not going to move the needle. It's not going to move the needle, and you need to apply for it. Yes, they've increased some of the things around it. These people are thinking, wow, the government's going to help me buy a house in the suburbs of Sydney. No, it's not. You're going to buy an apartment.
Yeah.
I can't live in an apartment because I've got 3 kids. Where am I supposed to live? This comes back to the structural reform needed to get Australians to build more properties. We need to build more properties. How do you build more properties? Get more tradies.
Yeah.
How do you get more tradies? You don't pay off kids' HECS debts with university degrees who are probably working as baristas at the moment.
I couldn't agree more.
Just saying it, right? Like that's university's cool. I paid off 3 degrees.
No, I agree.
I didn't get a handout.
It's a very perverse economic incentive, and everything that we're talking about here is you're incenting consumers to do X and Y, and I think we're incentivizing people to go in the wrong way because we've acknowledged we've got a skills shortage, and we're not making it more tempting for people to get a trade.
Why isn't the government coming to talk to people like me who have a different view of probably the people they're getting their advice from?
Because they're trying to win the votes of, I think, 18 to 25-year-olds.
Yeah, that's
that's all I can, and I mean that not as a smackdown. I mean that looking at the HECS cuts, the serviceability, and look, if you're not able to borrow, because you've got a $20,000 HECS set, you're not getting a house anyway. I bought
most 18 to 25-year-olds shouldn't be in property.
Yeah,
because they can't. They don't make enough money unless they're doing what we see when we speak to people on this podcast. Super focused, going out, going without a whole bunch of stuff and spending all their time, energy, and effort on investing in property, right? 18 to 25-year-olds, you're not going to be property investors, I'm afraid. You're not going to be able to buy your dream home today, right? No one's putting, $50 billion into the idea of shaping the mindsets of younger Australians about what is realistic around property and property investment or buying your own home. You don't see that anywhere. So, it's frustrating, right? Where is the big, bold, ambitious plans? Why don't they double? Here we go. Double what apprentices get paid. Double it straight away. I'm sure someone in Treasury can model that up.
That would probably equal your 20% HECS debt forgiveness.
Probably.
I'm plucking a figure. But
just double it. Double what tradies get paid.
That's a pretty big pool of money.
Yeah.
That $20 debt forgiveness.
Yeah.
So there you go. There's a pool of money that you can reallocate.
Yeah. Make it more attractive.
And then actually, the frequency. I mean, we've seen the productivity drop. The productivity between for each worker on a work site is dropping. Now we can talk about the CFMEU, but we won't. But there's a lot of reasons that go into this. Well, there you go. There's a way that you can fix a bit of a productivity gap by having more workers enter, more houses, therefore the people with the slightly larger HECS debts because they didn't get their 20% forgiveness. Yeah. Well, there you go. We've just doubled the supply of houses, so you can actually buy a far cheaper house. Done. So
this thing I was at yesterday, someone made the observation is that we're still building houses the same way we built them a decade ago. A century ago. Nothing's really changed. Everyone talks about automation and all that sort of stuff in every other industries. It's still really analog, the construction sector. And the point being, there needs to be a lot of changes in how that happens to increase productivity, to your point. There's a point here investing $54 million in prefabricated modular home construction.
I'm interested by that.
For off-site prehab foam.
I mean, that interests me. And that actually,
that's something at least, but $54 million ain't a lot of dough. Yeah. That's not a lot of money at all, you know. But then again, you change how we build and how quickly we build. You got to change all the rules and legislation.
And that credit to the government, that actually did interest me quite a lot to have the modular houses and the pre-cut houses. Yeah. If that is a way that you can just really drive efficiency, well, that's actually that's a solution.
Plonk it on site, but then again, most people think a modular home is a caravan.
You do picture that, like the demountables that you see in schools.
Yeah.
That's
and it's something very different. There's some very architecturally well designed stuff these days. So that's my summary would be the same. It's really ho hum. Like this, but this is a budget for 4 weeks for the election, right? This is not. This is not a real. This is not. If this is a real budget, if this is what the government actually if this is the best the government can do to give Australia a future around housing,
we're in a problem.
Yeah, we're up. No, we're certainly up there because is this the best we've got? I think probably giving a sentiment that most people would think, which is, to my point, is this the best we can do?
Yeah, it's
you're going to give me something before that.
Price gouging. So the government's come out promising a review. Oh, by the way, we've already had reviews into price gouging at Coles and Woolworths. Now, I know I'm probably going to get some emails about this. If you have any complaints, liam.garman@momentummedia.com.au, and then maybe we can jump on a podcast and debate it. But
sure.
I don't want to seem, what's the in vogue term, bootlicker for Coles and Woolworths. That's not my intention with this. But my understanding is for the average item at Coles and Woolworths, there's about a 2% markup. Now, why does that equal billions and billions and billions of dollars? It's because we all go out and we spend hundreds and hundreds and hundreds of dollars a week at Coles and Woolworths. I'm about 100 kilos, Phil. I eat a lot. I probably single-handedly...
You were 100 kg?
About 90, 98, yeah.
Really?
I rounded it up for dramatic effect.
Yeah, there you go.
For dramatic effect. But I probably put someone at Woolworths to a job,
Yeah.
just with the amount of calories that I consume. That's how they get to billions of dollars in profit. It's a sum. It's a sum of a lot of 2% profit margins. Now, what does that mean? A 2% profit margin in today's economy goes with the next Middle East oil crisis, right? So we saw Houthi rebels in Yemen targeting shipping. What does that mean? Shipping goes all the way around the Horn of Africa. Voila, oil prices skyrocket up 20-30% a day. Right? That completely erodes the Coles and Woolworths profit margin. Now, this is me defending Coles and Woolworths. There's a lot of economic factors that go behind this. And even if Coles and Woolworths completely eradicated their profit margin down to zero, that $3 Coke Zero you're getting is now $2.50, or $2.90 even. Well, it's not really going to mean much on your back pocket. So now one of the big promises for the government to address costs of living is another review.
I saw the Prime Minister on Insiders on, which is a show on ABC, if you don't tune into it, around politics and stuff. He couldn't even define what price gouging was. And I think Spears, who's the host in his position, was, well, Australia's already pretty good in this regards in policing its supermarkets, right? But again, it's just inflaming the sentiment of Australians who go,
it's just
all the reasons why the cost of living is so high is because I'm getting gouged at the supermarket shop. No,
nothing to do with us.
I bought a steak the other day, to be fair,
Yeah.
like from Woolies or Coles. It could have been even Aldi, right? One steak, a sirloin, it was a reasonable size. It was like nearly $20.
Yeah.
And I went, pretty expensive for a steak, right?
That's
like it wasn't the
yeah.
cheapest steak they had, right? Like it's expensive to live, comparatively. But you look at Australia, globally, our wages are a lot higher, even though our cost of living, the cost of buying goods and stuff. But it's something very, very different. So, mate, I don't know where we're going, personally, as a nation.
Yeah,
Like,
that ties into, it's not a long-term view, the price gouging buys, the $150 energy rebates. So what you're saying is you're going to invest billions of dollars in energy rebates without addressing the cause of why energy is so expensive.
Yeah. Everyone's up in arms about the coalitions or the opposition's sort of response to it around trying to form and secure our gas reserves, right? So let's not export as much as what I do, keep some here. Like Australia used to have the cheapest, largely comparative energy in the world. Yeah. Now it's really expensive.
It wasn't that long ago.
It's energy policy, but you can't do anything these days without someone saying don't do it.
Yep.
I can't do that. Everything needs to be, the big sort of climate change boogeyman, right? I'm not saying that it is a concern, obviously, but I'm not seeing anything from the government which gives me great faith in generational change for Australia. Yeah. It's just like we're spinning our wheels. We're just going from one political issue to the next. Who's going to stand up and actually say, let's actually do some change, which we're not going to see in a year or 2 years' time? Who's going to be bold and ambitious enough to actually say to Australia, we need to be thinking 50, 100 years ahead.
Yeah. No, I agree.
It doesn't win votes. That's the issue. $150 energy bill relief, like...
Yeah.
Like $150. It's like, it's a couple of packs of smokes.
Yeah.
Really?
Yeah, and then what you're doing is what you're just adding to the national debt to pay for it.
Yep.
Because we're going to have to pay for that at some point.
Well, it's going to be inflationary.
The last thing that it's going to be inflationary,
and the swan song of the big claim of the federal government is, we've had two years of surplus, but now there's a lot of red moving.
It's
through.
a lot of red.
And the only reason why they're in surplus is because we sold more stuff. They got more tax receipts than they expected. Wasn't through good management.
Yeah.
Well,
iron ore.
They were lucky.
Iron ore and stamp duty.
Yep. And stamp duty, don't even start me on state property tax. It's.
I mean, if you want to talk about what's making a lot of stuff unaffordable, imagine you've done all the right stuff. You've saved, you've put away, you've invested, you've not had your avocado toast or whatever, and then you go and then suddenly it becomes unaffordable because you're handed a $70,000 stamp duty bill.
Yep.
Just mind blowing.
Yeah. Which I think stamp duty is about 50%. I'm generalising, about 50% of all state government revenue is through stamp duty. Yeah. It's a lot.
I wouldn't be surprised.
Yeah. You think about it, right? So just think about how and this was my argument. We spoke about this on another podcast, Contested Ground, where I said property is one that ever talks about critical infrastructure being like energy and gas and all this sort of stuff, agriculture. I said property is probably the most central critical infrastructure for Australia. If property transactions fuel 50% of the money that state governments spend in their budget for all these goods and services they provide, it's pretty important.
That's massive. Yeah.
It's pretty important. And here we are talking about $54 million in the prefabricated homes. We're talking about shared equity schemes to government. The government becoming co-investors with Australians, right? I tell you what, like who in the government's actually making? Does the government have its own buyer's agent who actually says, think about this, right?
Yeah.
If me, that's me now. So I'm co-investing. The Australian taxpayer, I'm co-investing with all of these sort of first home buyers. I think what's the government contribute for 40% of the thing? So that means the government is a property investor, right? Who's advising the government whether or not an investment is a good investment, whether or not if someone buys that home that everything goes wrong, they're going to get their money back? Yeah. Who's actually saying if we're putting 40%, the Australian taxpayers putting 40% in co-investing with Australians, I want that 40%. If that 40% equates to $100,000, I want that to be $200,000 in 5 years' time because someone's made a good investment in the right spot. So the government's going to get their money back.
Be in the right spot.
No, it's not.
Yeah.
Who's helping?
Yeah.
Who is the government buyer's agent?
Yeah. I mean, you've got some fantastic examples around Sydney, in particular the like units around Parramatta.
Yeah.
Where it's like bought 10 years ago, sold 10 years later, exact same dollar price. Because now you've got those elements of oversupply as well.
So the government's tying up all this dough in real estate assets, right?
And probably also driving more inflation by adding fuel to the demand fire.
Yeah.
Now we've also got on the note of the demand fire. So the opposition on Thursday came out with their budget in reply speech. Yeah, again, feel pretty. I'm not inspired. Maybe marginally better, but I also, hindsight. We don't really know. Now, if anyone from the coalition is listening, any media people, you got to get the releases out quicker. I was there until about 10:30 on the budget in reply night and then still couldn't find the details of the policies. I saw Dutton's speech in Parliament, wrote it down, old school by hand, didn't get anything through. Very annoying. But now, that's not what we're going for. Two flagship policies that I took, or three, 25% reduction in migration, 25%, it's still probably going to be bigger than the long-term average, so I don't really see that being a real change there that we need to be concerned of or aware of. The big ones, $50,000 for first home buyers to take out of their super. Now, I was initially against this. I have to admit, and I've been on podcasts before saying I don't think it's the wisest idea because now you're going to suddenly have hundreds and hundreds and hundreds of thousands of young Australians, potentially boosting their borrowing by far more than 50,000 as well. So you're going to add real inflation to the asset class, and the SMC, the Super Management Council. Let me check that. Came out saying it's going to add about 10% to house prices. So that they're against it. Now, I've been dwelling on it because I do think it'll add flame to the asset class, but you can't access super until you're in your late 60s. You know, there's going to be so many hundreds of thousands, if not millions of Australians that are contributing 10% of their income every year and end up with millions of dollars and end up just dying 5 years into it.
Yeah, and you don't know how the rules will change when you get.
And you don't know how the rules are going to change. We're
nothing.
already talking about taxing super more.
Yeah.
With taxing. Have you been following the unrealised gains?
Yeah,
taxing?
mate. It really alarms and concerns me. How can you tax someone on unrealised gains?
That's
Again,
wild.
it's just another gouge, right?
Yeah.
Like, I'm getting sick of all this tax. Like, you know, I don't mind contributing. I think it's a great place to live, Australia. I'm happy to contribute, but sometimes that contribution doesn't feel fair.
I genuinely don't understand how you tax an unrealised gain.
I don't.
Odd.
I fundamentally don't have an issue with extracting super, and the reason why. You know, for those people who have saved a deposit, it might just be that final amount that gets them into the market sooner, right? And the sooner you're into the market, on the basis that you buy a good property, whether it's owner occupied, you know, and this is for the purpose of owner occupied, you know, that's the owner occupier home you buy today is most likely not going to be the owner occupier home you're in 10 years' time. You only look at transactions, right? People transact, and the idea being is that, you know, you're creating wealth and therefore you're going to have a better retirement as a result of it. But, you know, accelerating that makes a lot of sense. It won't fundamentally change people's ability to borrow money. It's just going to get them a deposit faster, you know, but they're still going to be considered on their serviceability of the income they generate, right? So I think it's an advantage in the head state. Yeah, it might put a bit of upward pressure. I'm sure some smart people have modelled it, how that might act, but it's not going to be a frenzy of activity. Right? Yes, there will be some consequence, and most likely in certain areas. Now, it's not going to mean that the house that you wanted to buy here, now you can buy a house where you really want to buy, because it's still going to be capped on your ability to service the debt. Yep. Now, that said, you might have a smaller mortgage as a result of it, but if you think about $50,000 within the realms of a mortgage of $600,000 or $700,000, or less than that if you're not in the capital cities, yeah, it's not going to do too much to drive and push it. So I think it's not a bad idea. I access my super for investing in property, but I do it in my self-managed super fund. Yeah, you know, for the purpose of investment. You know, so why, if it is for the purpose of investment, now your super lobby groups, you know, retail and industry funds who don't like SMSFs.
Well, yeah, they don't want the pool of funds managed getting smaller,
and they want that money sitting under their control rather than as individuals. Of course, they're going to give you every argument under the sun why it's a bad idea and how people are going to be worse off in retirement as a result of it. A lot of it is scaremongering. A lot of it is scaremongering. You spoke about this at the start end of this, around sort of the transfer of generational wealth and how you have, you know, this we talk about vote buying of the 18 and 25-year-old, right? So the government's out there trying to buy their votes with, you know, reductions here and $150, you know, in energy here, right? Those people who aren't homeowners today, who they're going after that vote, they will be homeowners at a point in time. And I tell you, they don't want their property to go down. You know, once you're a homeowner, you want your property to go up. Now, the issue that we have is there's a lot of sort of vitriol against boomers who, inverted commas, have all the wealth in Australia through their real estate assets and make it impossible for people. It's a whole bunch of people sitting around waiting for their parents to cark it in order to get that transfer of wealth. Now, that real waterfall is going to happen in about 10 years' time. Now, the sad story for a lot of people who are thinking that I'm going to get an inheritance and when I get my inheritance, I'll be able to buy a property. Most people's parents are probably going to die in their 70s to 80s, right? Which means that at 90s or even 100, right? They're getting older and older and older. So those generations, what are they now? Millennials or you know, who might be in their sort of early in the mid-20s.
Oh, that's Gen Z.
Gen
Z's 20s.
Yeah.
Millennials 30s.
30s. Okay, so Gen Z's, right, who are thinking, oh, one day I'll be able to buy probably when my parents die. They're probably going to be about 60 when that happens.
Yeah, it's true.
Imagine sitting around for 40 years going, I'll enter the market when I can. The only way I'm going to be able to get a deposit together is when my parents pass away. You're going to be 60. You're pretty much 3/4 of your life done.
Yeah.
You know, that's a bit sad to think about. And bring this back to property investment and why a lot of people who tune in this show take action is because they know when you're at that age, you can actually enter the market if you think about things differently. So we're sort of caught up on being really underwhelmed by the government budget, you know, and what do you do about all this? I tell you what you do with it, you just ignore it. Don't worry about it. Doesn't matter. Doesn't matter. None of this really matters. None of this. All of this, I look at all this here, none of it matters to me.
I don't see it shifting a dial.
None of it matters. You know?
I think, Phil, if there was a key takeaway policy, we would have highlighted it.
Yeah.
And we would have spoken about it in depth. I'm seeing a lot of dancing around. So I don't see there being something that we need to warn our listeners of.
There is nothing here which has changed anything that I'm doing. If anything, I just go, okay.
Yeah.
And I get frustrated by the fact that I get frustrated with the lack of action here, you know, and I just don't get it. I don't understand it.
You know, the only thing that I'm thinking about doing is doing a Mickey Mouse degree in my spare time because if the government's going to forgive it anyway.
You're getting discounted degrees.
What? Oh, take another one. Just another
Australia,
one.
discounted degrees.
Yeah, the taxpayer will pay it off.
Yeah. You don't need any more degrees.
Yeah.
You just don't need
I
them.
definitely don't.
You don't need them. But,
No,
you know,
but yeah.
Anyway, so when the government put together these think tanks about how to shape housing policy, why don't you come and have a chat with us and get a different view rather than, you know, people looking through the wrong way of a telescope.
Or if we're so egregiously wrong, come on and tell us why.
Yeah, yeah, and the point being, one of the cohorts they're probably looking to satisfy with this particular thing is making housing more affordable and therefore rents more affordable. They haven't achieved that.
No.
At all.
No, definitely not.
At all, because it comes down to supply. You know, it comes down to supply, and you're not making enough houses. I run through those stats. Anyway, well, that's our sort of rant. So, federal election on 3rd of May.
3 May.
Australia will go and vote. Now, if you're making your voting decisions based on whether or not you get $150 rebate in 2 tranches of $75, like Australians aren't that dumb.
Yeah.
Australians aren't. Maybe I don't know. Maybe I'm.
I don't know. I've seen some pretty interesting Facebook posts.
I'm going to vote for the government because I'm going to get a 2 times $75 rebates.
Oh, but you know, I've seen people on Facebook being like, "Well, my energy prices have gone down." No, they haven't. Yeah. You're paying through your own tax. Yeah. You just borrowed from some financial institution to pay.
Or some sovereign. Probably buy. Yeah, it's just increasing the deficit. I just don't understand why Australia can't manage. But why do we got to be in negative rather than positive?
For spending. It's because no one actually wants to, you know.
Like I sit there and just go, how do you balance your budget? You make more money or you spend less. And typically you want to try and do both in unison. Now, the government makes all their money through tax, right? Yeah. So it's a tough thing, right? When you're on one hand promising tax cuts and at the same time, you know, trying to get the budget under control.
Oh, don't get me started. Hey, did you know there's like 450,000 people in New South Wales that work for the state government?
Is it 450?
Something like it's in the 400s.
Well, you see the government currently attacking the oppositions on a scaremongering campaign, saying they will rip the backside out of the public service.
Oh,
that's
don't
the
do
big
that.
thing. Yeah.
Oh, geez.
No, there's safe jobs for everyone. Now people work yeah.
You know, and or you can't trust Darton, you can't trust the Libs because they'll send the public servers back to the office. All right, like if you're a productive worker, that shouldn't actually be a concern.
They're going to steal
for
your
you.
Medicare. That's what they're going to do as well.
Well, I was gobsmacked with that 450 or 400 something thousand.
Is there that many?
Yeah, because I didn't understand the maths. Because New South Wales is like 7-8 mil, and not everyone works. You've got the young, the old, the primary caregiver at home. So your actual tax base ain't big. I couldn't imagine the tax base is more than 4.5 million. So you're telling me at this point, we well over 10% of people work for the state, let alone federal government.
But you know, like your bins, your potholes, they're all done by your local government.
Well, I think council, my understanding, my guess would be that because council's technically an arm of the state government. So I'm guessing maybe council numbers were included in that.
Local council.
I'm guessing.
So that,
I'm guessing. If it's not, if council workers aren't included and it's 450,000 just for the New South Wales government, I would be mortified. I'm mortified.
Yeah, I've never really thought too much about it, but like, you know, the pool attendant at your local pool or the gardener doing stuff, I thought that was all local government.
It would be local government, but it just depends how they would cut it up because local government's technically an arm of the state government, is my understanding. But and they, I'd prefer the attendant at the local pool and the garbage person rather than the people sitting in Macquarie Street doing another policy analysis on another thing, on 100-something grand a year with their RDOs and time off, and because they also get every time you do an extra hour, you get it added onto your annual leave. Just what? Yeah. So up until I think it's up until just before you get to director level, if you do hours of annual leave, if you do an hour extra above your 9 to 5 or whatever it is, it gets added on your annual leave.
So everyone's just rorting their
It's raw.
time
I know there are people that I was speaking to once that said they didn't want a promotion because they were racking up so much annual leave.
So if you do 1 hour extra on one day, you get another hour of annual leave.
Yeah, it gets summed.
So if you do 7.5 hours of extra paid work a week,
I'm going to have to guess there must be some limit. But I have met people that were like, "Oh, this is absolutely cruisy. Why would I get a promotion?" Which is just wild. That why would I do more? Hey, why would I desire and strive for excellence when I could just work for the government, get everything for free, not try?
And what they do, the government's got its hand out every step of the way, looking for its tax dollars.
Super's next.
Next. Yeah, oh God, I don't know. It gets to a point where people are just going to go, you've taken all the incentive out of trying to get ahead.
Yeah.
If the government has got its hand in your back pocket every step of the way, I don't mind contributing and participating in being part of the tax economy. It's a great privilege to do so. But it gets to a point where it's just too much.
Yeah.
And I tell you, and this is an alarming thing, and bringing it back to property investment, I know I actually spoke with a property investor yesterday who I would say is pretty experienced property investor, who expressed to me something which I'm hearing more and more again. They're going, I'm done with it. I'm done with residential property investing. I can't make the numbers stack up anymore.
Yeah, wow. Concerning.
It's hugely concerning, and that thing I sat through yesterday, or listened to, they said the churn on rent rolls is huge at the moment because people are getting out, right?
Oh, that's very true.
It's very true. Very true. And let's be really, really clear, and back to my point, if you just keep hitting us time and time and time, and property investors just keep hitting us with more taxes, gets to a point where you just go, I'm done. I'm out.
Yeah.
That's it. I'm going to put my money somewhere else. Put in the share market so you can lose it all because of tons of tariffs, right? But it gets to a point where they just go, it's uneconomical for me anymore. And the benefits are now not outweighed by the negatives. It's an inverse. And for a lot of property investors, now an inverse equation.
And that's where you're going to suddenly have a real hit to supply as well.
That's your biggest issue.
Because why would
Rents are going to go up.
Yeah.
It's going to be harder to get a.
Why would you put money in? Why would you take money out of your own back pocket to drive the construction of your homes? It's just not worth it.
It's just not worth it. It's not. Yeah. It's not worth developers building now. They can't. They can't develop for a profit. So they're not going to do it. And you're seeing it all over the place where there's just stalled developments.
Yep.
Like people are just going, no, it's not right for me.
No,
they're selling it off. But if you keep taking and taking and taking and taking, I'll tell you what's going to give. You're going to get a property economy that's skewed and not going to have enough rental accommodation to house the people that need them. And you're not going to be able to fix that easily by funding $1 billion for crisis and transitional accommodation. That's just one very small and I would say very important part of what the government needs to be providing. But it's going to just be a watershed and then it's just not going to be enough.
Yeah.
So be careful, governments. Be careful not to take too much from property investors.
Your wealth base just completely eroded.
Gone. Anyway. There we go.
Good, eh?
So let's see what happens on the 3rd of May.
We'll have a special election episode.
We should do.
Yeah.
I actually did one last year live where I kept sort of coming back on live and not about what's going on. Maybe we can do the same. We get some do as a live stream or
that
something.
could be fun.
Yeah, about what's going on. Anyway, well, thanks for tuning in. I hope you got something out of that other than us just moaning.
Advising. No, not advising. Definitely not advising. But they're pulling apart. Yeah. Just analysing.
Analysing and moaning. And the two key important points are, number one, nothing in the budget which is going to transform Australia's property market. Unfortunately, someone's got to step up and someone needs to change it and actually do long-term generational planning rather than just trying to win votes. And number two, if you take too much, eventually you're going to erode the property market, and all of this is irrelevant because people just won't invest anymore. That's the Smart Property Investment Show. Lots going on. Liam and your team, you're pumping out really good stories and analysis all over the place. smartpropertyinvestment.com.au. Go and check it out. Please keep those reviews coming on this podcast. Please, we'd like the reviews. We don't get enough of them. The reviews we get is not really keeping pace with the listens we have. So please, if you can just leave some comments, some 5 stars there if you like what we're doing here. This is giving you an independent voice around property investment. We're fortunate now. There is so much out there in terms of property and property investment. But there's a uniqueness of the Smart Property Investment Show where we'll give you what we think without bias or agenda. Without fear or favour, other than ensuring that we're trying to craft and curate a better environment for property investors to continue to create wealth through property. So that's what we do. You can follow us. I'm on LinkedIn. Lean's on LinkedIn. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.